My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject Financial Analytics as prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 4 first important short question is Equity Valuation. Equity valuation means finding the fair price of a company's share, stock. It helps investors know if a stock is overvalued, too costly, or undervalued, cheap to buy. Simple example. Imagine you want to buy a shop. You'll check how much profit it makes, future growth, and compare with similar shops. Similarly, in equity valuation, we check company's profits, earnings, future growth potential, industry and market conditions. Common methods. 1. Dividend discount model, DDM. If a stock gives regular dividends, we calculate the present value of all future dividends. 2. Price to earnings, PE ratio. If a company's PE is 10 and its earnings per share is 20 rupees, then stock price is equal to 10 times 20 is equal to 200 rupees. Easy tip to remember. Earnings, dividends, growth, know before you invest. Equity valuation helps investors make smart, safe decisions, like checking the price tag before buying a product. Next important short question is 2. Variance. Variance tells us how much the returns of an investment move up or down compared to the average, mean, return. In simple words, it shows the risk or volatility of an investment. Simple example. Imagine two students. Rahul scores 70, 71, 69, very consistent. Rohan scores 50, 90, 70, big ups and downs. Even if both have the same average score, say 1970, Rohan has higher variance because his scores vary a lot. Same way in investments. Stock A, returns are stable, low variance, less risky. Stock B, returns jump up and down, high variance, more risky. Easy tip to remember. Higher the jumps, higher the variance. Formula, basic idea. Variance is equal to average of return, mean return, superscript 2. Variance helps investors choose between safe and risky investments. It's like knowing how bumpy a ride will be before taking a journey. Next important long question is 3. Coariance Matrix. A covariance matrix shows how different investments move together. It helps in understanding how returns of multiple assets, like stocks, are related to each other. Simple example. Imagine you invest in 3 stocks, A, B, and C. If A and B move in the same direction, both go up or down together, they have positive covariance. If A and C move in opposite directions, they have negative covariance. Now, when you want to build a portfolio with these stocks, you need to see how each pair behaves. The covariance matrix is like a table that shows the relationship, covariance, between all stock pairs. Easy tip to remember. Matrix is equal to map of movements. Use. It's used to reduce risk by choosing stocks that don't move in the same way. This is called diversification. In short, the covariance matrix is a powerful tool to build a balanced and smart portfolio. Next important short question is 4. Industry analysis. Industry analysis means studying a particular industry, like IT, pharma, or automobiles, to understand how well companies in that industry might perform. It helps investors choose the right sector to invest in. Simple example. Imagine you want to open a shop. You will check Is the demand for this product growing? Who are your competitors? Are government rules helping or hurting the business? Same way, in industry analysis, we look at 1. Growth potential of the industry. 2. Competition level. 3. Government policies and trends. 4. Consumer demand. For example, in 2020, the IT industry grew fast due to work from home trend, while aviation industry struggled due to travel restrictions. Easy tip to remember. Strong industry is equal to strong investment. Industry analysis helps investors pick sectors with future growth and less risk. It's like choosing the right field before planting seeds. Better the soil, better the growth. Next unit 4. Long questions. First important long question is 1. Calculation of portfolio mean and variance. Calculation of portfolio mean and variance, financial analytics. In financial analytics, when you invest in more than one asset, like 2 or more stocks, that group is called a portfolio. To understand how this portfolio performs, we calculate 2 important things. Portfolio mean, expected return. Portfolio variance, risk. 1. Portfolio mean, expected return. It tells you the average return you can expect from your investment. Formula. Portfolio mean, RP, is equal to WR plus WNRN. W is equal to weight of each asset in the portfolio. R is equal to expected return of each asset. Example. You invest 60,000 rupees in stock A, return 10%, and 40,000 rupees in stock B, return 6%. Total is equal to 1 lakh rupees. Weight A is equal to 0.6, weight B is equal to 0.4. Portfolio mean is equal to 0.6 by 10% plus 0.4 by 6% is equal to 8.4%. 2. Portfolio variance. Variance shows how risky your portfolio is, how much the returns can go up or down. Formula for 2 assets. Portfolio variance is equal to sigma superscript 2 is equal to variance of each asset. COV is equal to covariance between assets. Example. Let's say stock A variance is equal to 0.04. Stock B variance is equal to 0.01. Covariance is equal to 0.02. Same weights as above, 0.6 and 0.4. Portfolio variance is equal to 0.0256. Easy tip to remember. Mean is equal to money you expect. Variance is equal to volatility, risk you face. By calculating both, investors can create a balanced portfolio aiming for good returns with lower risk. Like mixing spicy and sweet food, not too boring, not too risky. Next important long question is 2. Capital Asset Pricing Model, CAP. The Capital Asset Pricing Model, CAP, is a formula used to calculate the expected return on an investment based on its risk. It helps investors know whether a stock is worth investing in compared to its risk level. CAP formula. Expected return, RE, is equal to RF plus beta times RF, where RE is equal to expected return on the stock. RF is equal to risk-free return, like government bond return. Beta is equal to risk level of the stock compared to market. RM is equal to expected return of the market. RF is equal to market risk premium. Simple example. Suppose risk-free rate RF is equal to 5%. Market return RM is equal to 11%. Beta of stock A is equal to 1.2. Then Re is equal to 5% plus 1.2 times 11%, 5%. Re is equal to 5% plus 1.2 by 6% is equal to 5% plus 7.2% equals 12.2%. So, stock A should give 12.2% return to be worth the risk. What does beta mean? If beta is equal to 1, stock moves same as market. If beta 1 more risky, moves more than market. If beta 1 less risky, moves less than market. Why is cap useful? Helps decide if a stock is fairly priced. Useful for comparing risky and safe investments. Used in portfolio management, budgeting, and pricing. Easy tip to remember. Cap is equal to risk-free plus extra for risk. Or return is equal to safe plus smart risk premium. Cap is like deciding if a roller coaster ride, risky stock, is worth the thrill, returns, compared to sitting on a merry-go-round, risk-free bond. It gives a clear idea whether you are being paid enough for taking more risk. Next important long question is 3. Estimating beta and security market line. What is beta? Beta measures how much a stock moves in relation to the overall market. It shows the risk of a stock compared to market movements. How to estimate beta? Beta is calculated using regression analysis, but in simple words. Beta is equal to covariance between stock and market variance of market. If beta is equal to 1, stock moves same as market. If beta 1, stock is more volatile, risky, than market. If beta 1, stock is less volatile, safer. Example. Let's say stock A has beta is equal to 1.5. If market goes up by 10%, stock may go up by 15%. Stock B has beta is equal to 0.7. If market goes up by 10%, stock may go up by 7%. Security market line, SML. SML is a graph that shows the relationship between beta, risk, and expected return of an investment. The equation of SML is the cap formula. Expected return is equal to RF plus beta times RF. X-axis beta, risk. Y-axis expected return. SML shows what return an investor should expect for a given beta. Example. If the risk-free rate is 5% and market return is 11%, a stock with beta is equal to 1 should give 11%. A stock with beta is equal to 0 should give 5%. A stock with beta is equal to 1.5 should give 5% plus 1.5 by 6% is equal to 14%. Easy tip to remember. Beta tells the bounds, SML draws the line. Beta shows risk, SML tells what return you should expect. Why it matters. Helps in comparing different stocks. Tells if a stock is overvalued or undervalued. Useful in portfolio planning and risk analysis. Together, beta and SML help investors make smart decisions based on risk versus reward. Next important long question is 4. Economic analysis and technical analysis in stock. To make smart investment decisions, investors use two key tools. Economic analysis. Technical analysis. 1. Economic analysis, macro view. Economic analysis means studying the overall economy to understand how it affects the stock market. Key factors checked. GDP growth, higher growth means better business profits. Inflation, high inflation is equal to less buying power. Interest rates, high rates is equal to costlier loans is equal to less spending. Unemployment, more jobs is equal to strong economy. Example. If India's GDP is rising and interest rates are low, it's a good time to invest as businesses are likely to grow. 2. Technical analysis, chart view. Technical analysis focuses on stock price movements and charts. It doesn't look at company fundamentals, but studies past price trends and volume to predict future prices. Tools used: candlestick charts, moving averages, support and resistance levels, indicators like RSI, MACD. Example: if a stock has fallen to a support level multiple times and bounced back, a trader might buy it expecting another bounce. Easy tip to remember: economic is equal to economy health, big picture. Technical is equal to trendy charts, price action. Why both are important? Economic analysis helps long-term investors understand market direction. Technical analysis helps short-term traders time their entry and exit. Simple comparison. Type focus best for example use. Economic analysis: economy, policies, long-term investing, is the market overall growing? Technical analysis: price charts, trends, short-term trading, when should I buy sell? By combining both, investors can make powerful decisions like checking the weather, economic, and traffic signals, technical, before starting a journey. Next important long question is: 5. Real option in capital budgeting. In capital budgeting, companies plan big investments like opening a new factory or launching a new product. But the future is uncertain. That's where real options help. A real option is the right, but not the obligation, to make a business decision later, like delaying, expanding, or abandoning a project based on new information. It's called real because it deals with real assets, not stocks or bonds, and option because it gives flexibility, just like financial options in the stock market. Types of real options. 1. Option to delay, wait until conditions improve before investing. 2. Option to expand, invest more if the project is successful. 3. Option to abandon, exit the project if it's not working. Example: imagine a company wants to build a 10 crore rupees factory. But demand is uncertain. Instead of full investment now, it builds a small 2 crore rupees plant. If demand rises later, it has the option to expand the plant. This flexibility has value, and that value is the real option. Why use real options? Adds strategic flexibility. Helps make better decisions under uncertainty. Increases the true value of a project, not shown in traditional NPV. Traditional versus real option thinking. Traditional NPV, invest or don't invest, no flexibility. Real options adds future choices, smarter decisions. Easy tip to remember. Real option is equal to real life flexibility in big projects. Think of it like a movie ticket. You pay now, but you can choose whether to watch or skip the movie later. In short, real options help companies deal with risk and uncertainty in capital budgeting by giving them choices, just like keeping doors open for better opportunities.